Good day, everybody. Few days back, I had posted an option trade which appeared to be very compelling to me, and I wanted to provide an update on that trade, and also I wanted to show you a few ways in which a trade like that can be adjusted if the market price of the underlying instrument goes against us. Now, this will only be relevant for people who do not want to be assigned and who are looking at exiting this position after some time and locking in their profits. However, for someone like me, I actually did this trade with the objective of buying the shares at a weighted average price of $1.82 per share. And for me, it really doesn't matter if in the interim the stock price keeps going down, because for me to be assigned, I need the stock price to go down. If the stock price stays above $3, I will not be assigned. So my initial objective does not get met. However, I will make a very juicy return on the capital which I have blocked for this trade. Also, please keep in mind the disclaimer that this is not a recommendation. This is purely an academic discussion to show how you can adjust your option trades. So first, what I'm going to do is I'm going to show you how the actual trade that I did on the 3rd of October 2019 looks like. Now, the picture on the left, that shows the stock price between April and October 2019. And the picture on the right, that is the payoff diagram, or what is also known as the risk graph of the option trade. Now, I will spend some time in explaining this. Now, this trade, it is just a short put. I had sold 200 contracts. That has an expiry of 21st January 2022, which is over 2 years from now, 840 days to be precise. And the strike price is 3. So on the vertical axis, we have the stock price, and on the horizontal axis, we have the profits. So you will see these three lines in the payoff diagram. The black line is the payoff diagram at expiry. So on the expiry date, if the stock price stays above $3, then the vertical black line shows the profit, and if the stock price falls below $3, then till the point where the payoff diagram passes through the axis, till that point the trade will be profitable, and below that the trade will lose money. The red line is the payoff diagram as it looks as of today. The green line is how the payoff diagram will look 420 days before expiry. So as you can see, with the passage of time, the red line moves towards the green line, and the green line will move towards the black line. So this is what happens when there is a time decay. So because this is a short option position, we benefit with the passage of time. Now, the total notional value of this trade is 200 contracts multiplied by 100 shares per contract multiplied by $3, which is the strike price. So the total notional value is $60,000. The cash inflow which I received at the time I opened the trade is $23,600. And the max risk, the max possible amount that I can lose if I do not do anything, and if the share price goes to zero, is $36,400, which is the notional amount of the trade minus the cash inflow which I brought in at the time I opened the trade. And the break-even point for this trade is $1.82 per share. Now, I think very conservatively. Because the notional value of this trade is $60,000, I have forced myself to think that I'm blocking $60,000 for this trade for a possible assignment. And on that capital, I have generated a cash flow right upfront of $23,600. So since I'm blocking that $60,000 for 840 days, so this results in an XIRR of 24.26. And as I explained in the earlier video, my actual return could be even higher because this $60,000, I'm not leaving it just like that. I'm actually parking in some short-term US treasuries, which also generates a certain yield. So my effective yield on this would be somewhere close to 26%. However, the most important thing to keep in mind here is that the $23,600 which I have just brought in, that is very similar to the insurance float that Berkshire Hathaway generates. Selling a put option is just like selling an insurance, and whoever bought the insurance paid me $23,600. So I'm free to invest this $23,600, and by the time when actually the assignment happens, my investment would have generated some return. So by the time that I have to actually pay the $60,000 for the assignment, who knows, the value of this 23,600, it could have gone up to, let's say, 40,000. So effectively that brings down my risk to just 20,000. And this is all with the assumption that the stock price of Jumia can eventually go to zero, because that's the only way I will lose my entire notional for this trade. But the $23,600 was already in my pocket. So I can go ahead and invest that $23,600 in Berkshire Hathaway and generate a return, or maybe in any other stock which I like. A few days later, which is on 14th of October, which happens to be yesterday, the stock price of Jumia took a further dip, and yesterday it closed at $6.2. The day when we opened the trade, it was at $8.07. Now, again, in case someone wants to adjust the trade, if someone wants to protect themselves from a possible assignment, there are several ways of adjusting the trade, and I'm going to discuss some of those adjustments here. Now, in reality, the requirement for adjustment would only come up when the trade is very close to expiry. Now, this particular trade is no way close to expiry. It's still 830 days away from expiry. So there can be two requirements for adjustment. One is the stock price is significantly lower than the strike price of the option, and if the trade is close to expiry. Now, none of those conditions are met here. The stock price is still more than double of what the strike price of the option is, and we are still over 2 years away from expiry. However, to still explain the concept of how an adjustment can be done, I have used a proxy trade. So I have used a trade which actually is reasonably close to expiry, and also a trade for which the stock price is somewhat around the strike price. So this is a paper trade which I actually did on the 31st of July 2019. Now, at that point of time, the stock price was around $17, and I went ahead and sold 65 contracts of the $7.5 put. But these puts expire in November, which is just next month. Now, at the time of opening the trade, the expiry was 107 days away. So let's quickly go through the metrics of this trade. The total notional value for this trade is $48,750. The cash inflow that I generated was $2,000, $2,080. The maximum risk of this trade is $46,670. The break-even point for this trade is $7.18 per share, and in a non-assignment scenario, the XIRR would be over 16%. Now, subsequently, because the stock price has now come down to $6.2 and this trade is reasonably close to expiry, it's just a month away from expiry. So let's take the example of this trade and see how or what are the various ways in which we can adjust the trade. What is the objective of this adjustment? It's nothing but to reduce the risk of this trade. And again, that is if you think your assignment is a risk which you want to avoid. So the adjustment number 1 is a very simple notional risk reduction. How do we do that? We just go ahead and do a spread trade. I did the trade yesterday, which is 14th of October 2019. So I go and buy 65 contracts of the November 7.5 strike put, and I sell 65 contracts of the January 5 put. So just by itself, this spread is a calendar spread, and this is also a diagonal because the two legs have different expiries and the strike prices are also different. But in effect, what I have done is when I club this spread with my original trade, you can see I'm actually closing my original trade and I open a new short leg. So this is a way to roll out the original trade and also roll it down. So let's see what happened to the notional value of the trade. Now earlier the notional value was close to $49,000, whereas right now the notional value has just come down to $32,500. And why did that happen? Because I have chosen a lower strike, which is a $5 strike. Now I generated some additional cash inflow. So my total cash inflow from this trade is now $2,730. So I generated additional cash inflow and at the same time I reduced the notional value of this trade. And look at the maximum risk this trade has as compared to over $46,000 of max risk which was there earlier. Now my max possible risk has come down to below $30,000. And as compared to the break even of $7.18 earlier, my break even for this trade has also come down to $4.58 per share. So net, I have significantly reduced the risk of that trade, and at the same time I have generated some additional float which I'll now go and invest. There are a few different ways of adjusting this trade, and I have created few more short videos which you can freely download from moneywisesmart.com/research. Once you click there, you will be taken to our Teachable platform where you can register. Registration is completely free, and if you have already registered earlier, then just log in using your user ID and password and you will be able to access all those adjustments. And I will also keep posting ongoing adjustments in the same section. And I will also show you some interesting ways in which you can use the float that you have generated to create some new option trades that can significantly boost your returns. I also invite you to join our investment forum group on Facebook. The clickable link is provided below in the description section. And if you have liked this video, do remember to hit the like button and subscribe to our channel. We will keep posting several interesting option related positions showing you how to generate an ongoing cash flow and also how to reduce the risk of your positions.